Peter, how are you, bro?
Hi Dale. I'm really good, thanks. Yeah, how are you
Uh,
doing over there?
it's good to see you and hear you. And I want to start off with acknowledging and validating that when the S&Ps were trading under 4,200 at 4175 and then lower, you told your subscribers there was going to be a rally. I don't think you were looking for this type of magnitude of rally, but but who was? And anyway, great out down there, Peter. So
Uh, oh, thanks. It's nice to get an accolade. Yeah, I mean, I'm just sharing my screen, okay, so that you can see. Um, oh, hang on. Have I got the wrong screen share? Okay, I've got to sort this out now. Um, let's
yeah,
stop
you have the
sharing.
S&Ps up there, buddy.
Oh, is there an S&P? Oh, good. Oh,
Yeah,
okay.
yeah. So you're looking for a pullback from here. Let me ask you this.
Okay, good.
I see this count up here, which would be new all-time highs. And did you ever think, um, you know, last year or even, when, we were you were bearish against 4,600, say, that we would ever see all-time highs again before we had a much larger correction? Is this a
No,
curveball?
no, I didn't think that was likely. We haven't got that in the Russell, the small cap indices, and we haven't got it for several other things. But some of these markets have persisted higher. So I didn't think that we would drop down. I always thought that minor wave two, which we've designated as beginning the decline from the Jan 22 high up here.
Yeah,
I always thought that would unfold into a double zigzag pattern, and we get to lower levels, at some stage below 3,500. Um, but this persistent sort of run up from October last year, it seems that pattern, that double zigzag pattern, is changing into an expanding flat. And it happens
yeah.
sometimes. It can happen that way. I didn't
Can
think
I
it
ask
would.
you this, Peter? Someone else I talked to who uses it, he's not really, he doesn't even claim to be a great, that waves are his number one thing, but that's what he was calling this rally up at 4602, an expanding flat. And he thinks now we have an expanding flat within the expanding flat,
Okay.
um, but not new highs. So
Okay.
up here, it's an expanding flat and an irregular B. Is that what this would be? An irregular took out this high?
Yeah, I mean, if we take a look at the bigger picture, we have something like this going on, where we break that high up here slightly, just very slightly. This is the old 22 high.
Yeah,
So
right.
we break up slightly, and then bang, we're gonna come down really hard.
Okay.
Um, and
What? How
yeah, go
much
ahead.
time do you think the market has left to give us a pullback to correct this recent advance, and then make a new surge towards all-time highs? I know different people have different targets up there. Some as high as 5,400. There are melt up people saying 6,000. There are other guys saying, right around 4,800.
Yeah.
When do you think we'll be there? New Year's or in the spring?
Well, the interesting aspect to this is that if we were moving up from the 41.22 low in October as a five-wave expanding impulse pattern, when I make those terminologies, I'm talking about a five-wave pattern that has an
Right.
extended third wave, so a very typical Elliott construct of a five-wave pattern. If we did that, we would probably get up there by sort of January, and we get
Okay.
a sort of a welcoming sort of new year rally into the end of January, and then it would collapse from there. But from what I can see, and we'll get to know about this probably today or tomorrow, is that the upswing from 41.22 to current levels is more proportionally measured as a zigzag,
Okay.
which is quite interesting because let's have a look at I'll go to my worksheets where I can show you this. This is the advance from the October low at 41.22. We've got a five-wave advance getting into mid-month, a very tiny correction, and then another five-wave pattern. And if I extend the first sequence by 61.8, I'm going to get a target at 46.02 today.
Oh, see, and I had a discussion with Blake, so Blake's going to get his 4,600. Okay.
Yeah, I think it's possible. It doesn't need to go there, but I think it might be that in the first hour of trading, we get a little bit there, and then suddenly you might find that it lingers there till about New York lunchtime, which is normal.
Month's end, that things don't change until next month.
And then this would then, if this zigzag is unfolding like this, then it becomes part of a diagonal impulse, not part of an expanding impulse.
Okay.
And the diagonal impulse, if it's a diagonal, the zigzag is obviously consistent with wave 1 of the diagonal.
Okay.
The second wave by default is normally a 76% retracement. Okay, so we're going to measure then 76 like this up to 46.02, and you'll see it's going to come in. It's going to come in around 42, 42.30.
All right, so that's only 100 handles away from the low. What if, and you know, things change, right, Peter? What if we take out that low?
Well, I mean, if it takes out the low, then I think we could be already starting to look, which we originally thought would happen, which would be that we would start this next bigger decline. You know, if we go back to this weekly chart, then we would start this process down to 28.79. Almost certainly, if it breaks that low, you're going to start an avalanche of selling.
So there's your line in the sand, bulls.
That is the line in the sand. Yeah, that is the line in the sand. But I have to admit that one of the things which crossed my mind, and which we're talking to some of our institutional clients, is this correlation between, say, stock indices and the fixed income markets, particularly the yields, 10-year Treasury yields.
Yes.
See, at the moment, the market's pricing in about a 25% probability of a rate cut in March, in the March meeting. Suddenly, with this sort of slightly lower CPI numbers that we saw in the week before in the CPI in the US, and Jerome Powell's remarks after the Fed announcement last month, the market's basically pricing in too much of a rate cut too quickly. And we can see that in the 10-year. Have a look at the 10-year Treasury yields now. We've been up to 5% in October. Now, don't forget, this 5% number occurred pretty much at the same time that we had the 41.20 low in the S&P.
Yeah, it did.
And the S&P is moving up.
And the dollar high.
Right. So you've got the dollar going down at the same time as this is going down. The yield is going down, and you've got the inversion of that, and the S&P is moving up. Right. So what have we got there? We can confirm the correlation. If we do get the S&P dropping down for the next 2 weeks by about 8% in the short term, that's going to flip the yield up a little bit before it heads down later. But in the bigger perspective, if we pan out a little bit and we're saying, right, well, the S&P, once it gets down to 42.30, it's going to have a run up here like this.
With yields dropping towards your 360 target?
That's correct. So we get down to 368.
Okay.
We get down to 368. And then when, for whatever reason, we start to turn back up to continue primary wave 5 as a diagonal, we're then going to get the next big sell-off here.
So you're going to have ending diagonals in the 10-year yield and S&Ps. Interesting. Do you
find they're different? They're different dimensions. You know, they're different degrees of trend and different timing. You know, don't forget, here we're saying negative correlation. So this is coming down 42.30 at that low.
Because yields are bouncing.
Yields will bounce up a little bit, up here before they drop down again. But what we're saying is that this low at 368 will coincide with this high at 49.50.
Right.
Okay. And then when this begins to collapse lower, so this third wave of the diagonal starts to work its way back up. There's no way that primary wave 5 is finished. The market is assuming that primary wave 5 is finished up here at 5%, but it's not. It hasn't. We can't get a 5-wave pattern in that subdivision, in that move from April's low up to October's high. And we can see that very evidently in the way that Europe's yields are working as well. I mean, if you aren't convinced by that, you should be by this pattern, because here's the same equivalent low in March, April, which began primary wave 5 in the bund yields here in Europe.
Right.
But you can see that there's no way that you can count 5 waves in that swing. Absolutely not. So yeah, I think these are, I'm a bit sympathetic to the idea now that the S&P will drop down here, but it will continue moving up like that. I don't think we'll break 41.22. As you've said, if it does, yeah, it would look very, very bearish. That's the line in the sand for the bulls. But otherwise, I think that there's a good chance that these two things, looking at the way that 10-year Treasury yields are working in conjunction with the S&P 500, I think this is the way it's probably going to work.
You know, someone, Blake was talking about copper, and I know you follow it. And I thought we were breaking down, you know, for the last 2 months. I was making jokes like, you know, Dr. Copper is being sued for malpractice by impersonating a bull market.
Well,
anyway, looks like he won the suit, and Copper's, this is copper. This is what you have up here right now.
This is copper. This is LME copper.
Okay.
You know, I plot the LME because, you know, my background is I've been trading on the LME since the late 70s, and also it's a continuation
really
contract without.
Hey Peter, they were really crooks on that floor.
On the LME floor.
Oh, you always got the worst fills at the LME compared to the US.
Oh, really?
Did you know that?
Well, I was actually the guy that was actually executing those fills. So thanks very much for the accolade on that
anyway,
one.
I just wanted to let everyone know that you're
thanks,
now,
Dale.
Now you have to be right.
Thanks very much. Thanks very much
very
for
welcome.
that. I'll give you I'll plead my innocence for the time being and give you a long story about execution fills.
There were many at the Comex and Board of Trade too, Peter. I'm just kidding.
Yeah, I mean, yeah, we always used to think the Comex guys ripped everybody else off. Now, so we've got a bit of a dialogue there coming.
All right.
Get your boxing gloves out.
Fair.
We'll sort this out.
All right.
Well, it's an interesting story with copper because, and I am sympathetic to what Blake was saying, you know, but I think overall, copper's having a bit of a hard picture in its development downwards. I'm going to show you a weekly chart, which might give a little bit more background to what should be going on here. We've got an inflation pop zigzag from the financial crisis lows. It's just off the side on the left here. Actually, I'll just bring it across a little bit. You can see that we had a low at $28.15 a ton. We had a nice 5-wave advance here, which is wave A of a zigzag, but wave C moving up from the 2016 low is taking the form not of an expanding impulse, which wave A has unfolded into. This is a diagonal. And the main reason for that, it has to be unfolding 5 waves, by the way, and it has to break above wave A's. Well, it's done that in effect already, but not in 5 waves. But this pattern is a diagonal impulse. It's an expanding diagonal. And it basically means that we're going to have this drop down to 6,000 or just below before it goes up again. We've got 3-wave activity in the first wave, 3-wave activity with a short hesitation. This short hesitation, by the way, is very typical of these zigzags in diagonals. You know, if you can remember what we looked at the beginning with the S&P, this is a very short B wave in a diagonal. Can you see that?
Yeah.
It's just like a short hesitation.
Nothing.
It's almost nothing.
And then the CPI came out and it was a rocket ship again.
Yeah, here's another example of a short B wave within an impulse sequence of a diagonal in these ending type diagonals. We've also got one, by the way, in the S&P weekly chart. Here's a short-term hesitation for the B wave of this diagonal. You see these B waves are very, very short, and they confuse everybody because they are so short. If I extend wave A here by 61.8, you know, you're going to get up to the top here, which is the perfect expression, Fibonacci expression of measuring that zigzag to confirm that it is what it is. But anyway, returning to copper, we've got to get this drop down to 58.70. So I think to some
You
extent,
think that'll coincide with the, because it's a economically sensitive commodity like WTI is, and I know you're bearish too, that they both continue to sell off while the yields continue to drop, market, and then they both kind of bottom together?
Well, I think this decline on copper, which necessitates this zigzag finalization for next year, is coinciding with that big drop in the S&P. So,
okay.
So this one, that's coinciding with this drop here. Once these are out the way, we're going up to new record highs, and copper is too, which is basically this one. But we've got these symbolic declines coming in this for next year on the S&P and copper. That basically is giving us an indication that we're going to see a recession. So all of this talk about soft landing and pricing in rate cuts for next year is a lot of hogwash at the moment. It's not going to happen. As soon as we start getting this rally finishing into and across the new year, and when the S&P then starts to drop down and we start getting copper dropping down, you'll get that equally priced out again. So you're going to get pricing in going into New Year, January, and then you're going to get pricing out afterwards. Okay, so we're not going to get a soft landing or no landing at all, which is what the Bank of America surveys are telling us what the fund managers are expecting at the moment. We're going to get that complete shift of sentiment once we get across New Year, the end of January. So once the January window finishes, we're going to get these prices all starting to drop down again, and suddenly we're going to be starting to sort of price out all of those rate cuts that they're currently being priced in, and we're going to start seeing more evidence of a hard landing, not a soft landing, you see. So, and this is very evident in crude oil. If you take a look at the crude oil price.
Yeah, you've been spot on with it. No war in the Middle East got you bullish.
No, I mean, that there's been the conception since obviously Hamas invaded Israel and took their hostages, but it hasn't materialized. In fact, that happened, and then we've got this big sell-off after that anyway. There's definitely a downtrend here. We had a 5-wave development for primary wave A in 2022 and a bit of 23. There's been a nice expanding flat pattern that's corrected that 5-wave decline. We're heading down now in another 5-wave decline, and it's just a question of what degree of trend and sequence do we have to get down there. I immediately extended wave A by 61.8 to get a target of about 47.72. Let's call it $48.
Do you think that'll be around when the S&P is 2,900 as well?
Yeah, that will
down there.
Yeah, that will coincide when we're down at 2,900 here.
Okay. Yeah. Wow, there's going to be so many different things to buy. But gold won't crash with the market on that sell-off.
No.
I don't think the dollar will still be going down during that sell-off, which will be different. Won't that have a lot of people off sides saying, where's the bid on risk off in the dollar?
Yeah, the dollar now has broken 104.80, which was nearby support week before last on that CPI number. When it broke below that, there was no way it would go any higher than it had already, which was October's high at 107.35.
Right around 50%.
So we're talking about over the next several years, we're talking about the dollar index halving in value. And there's going to be a sort of de-dollarization theme, which is, what we're seeing already with Saudi Arabia agreeing swap arrangements with countries like China and India, to supply them with oil. They're moving outside of the dollar remit. They don't want to have to transact their commodities in dollars anymore. There's too many fingers and too many hands into their business, and the old oil agreement going back to the 70s between the United States and Saudi Arabia is basically bust. It's defunct.
The petrodollar.
And this dollar de-dollarization is going to be taken into effect over the next several years. It's going to eventually wear the dollar down. And this is a longer term chart that you're seeing here, weekly chart. In the short term, we're trying to move down in a 5-wave sequence from October. The normal place for it to rest is probably back to July's low. It might break it slightly. That would be normal. And then suddenly it flips up in a second wave, which we don't know to the extent of how deep that might be. I've got some institutional clients telling me, oh, Peter, look, we believe the dollar isn't finished with its strength and it's going to have a deep rally before we get the sell-off, particularly if you're thinking that yields can later have another rally. Well, it might be that I've underestimated this illustration here for intermediate wave 2. And I might have underestimated wave 1 slightly. It might even break lower than this area. There's a lot that can happen yet because we haven't really got a lot to measure off from the development down so far. But
I mean, that was a pretty tiny wave 4, that bounce we had last week, Peter. If we get an S&P sell-off, don't you think there'll be any bid in the dollar? Maybe take it back towards 105, 105.50?
Well, it might do. I mean, I'm looking at it here in the very short term. You can see that we had the correction. It was a 38%. This is my worksheets. This is a 38% retracement of that decline, that 5-wave decline, which was a third. And you can see that it's almost dropping down into 3 waves at the moment. So if you were, let's put in a 6180 extension here and measure that up. And that comes in at 103.12. So it might just, you want to be watching today and just see if that nips there. And then you might get a 5-wave development like this coming up.
Yeah, that's what I'm looking for.
Yeah, and then it would, so wave 4 will end up as an expanding flat, something like that.
There's like a C wave missing.
Yeah, this would be wave A. This zigzag decline that we've measured here to 103.12 would be B. And this would be wave C coming up. And then you can extend, typically you can extend 38.23% here like this. And then you might want to see if that's hitting maybe the 38%,
halfway.
The 50% retracement number instead of the 38 number, which contained the A wave.
Right.
Yeah, so you're going to get somewhere up to here, look, somewhere in that band.
Shallow. Can you answer this question that I can't answer for people and I can't answer for myself? We've had this huge run in the physical gold market, physical silver market, and I know you believe platinum's bottom and it's going to lead the way. Why are
Hey, Dale, good morning. I'm sorry, we could barely hear you. Is your microphone close to your mouth? And good morning, Peter.
Yes, good morning, Blake.
Let me see if I could make a volume.
You're just coming in really quiet, Dale.
How about now? How about now?
Now's better. Yeah.
Okay. Why the miners are underperforming the physical market. And are they on a different count because they're underperforming? Most of them. Yes,
they are. I'm pleased that they're underperforming because actually they give us a chance to buy into those.
Well, yeah,
that's the good aspect of it, isn't it? But the question obviously needs to be answered. You're right. I mean, here's the GDX, and it's just starting to get going. I think to some extent, don't forget that bullion versus something like the GDX miners index, we're talking about 2 different asset classes, aren't we? Which are related through their business. So to some extent, equities have been dragging this down, and we have seen in the past, of course, during the big advance in when we bottomed in 2016. The advance was much more rapid here in equities. The bullion price was lagging behind. This one really sort of went almost tripling, or 2.5 times value. Bullion did something like 40%, if I remember. This did like 250%. So you're going to get disparities there, but I think it's okay. I mean, I think at some point when the market realizes that bullion is going to break out and gold's to break out of its triple top area. You know, I mean,
Yeah.
how many times has the market sort of like got it wrong and started talking about, you know, a breakout, only to find that it's actually been delayed.
Yeah.
We've had 3 tops here. Most people sort of bought heavily back in July, thinking it was going to break out, didn't it? Traded back down again. But you know, but this time I think that would set the miners alight. I've got clients who are buying a lot of miners at the moment, mainly because they haven't moved. They should catch up. It's a good opportunity, really. As you said, I prefer things like platinum. Platinum has also been dragged down recently, but I think platinum and palladium in particularly are my hotspots. I really like the way that they performed, especially this nice expanding flat pattern in palladium, which brought out the lows. We had a target way up here at 846. We got to 838.
I remember.
It's really nice.
Call. I in my head, for some reason, I thought it was 800. I forgot, but I remember that we were down there, and that kind of kept me on the right side of things until platinum bottom. That helped me.
Good.
You know, a lot of people are younger traders, and they don't even remember that platinum used to trade at 1,000 or better premium to gold. So would buying platinum, selling gold be a good pairs trade over the course of time?
Absolutely, it would be. Yeah, I mean, absolutely. I think you know, we've got you know, platinum, as you say, was generally always premium to gold. In my early time of trading, you know, in the 80s and stuff like that. And I think we got a platinum gold ratio here. And yeah, here we can see advanced gold outperformance. But, you know, going back to the 1980s here, you know, all this period going up to the 2000s, you know, platinum was twice as expensive as gold. Now it's half the price. So you can see the big swings in the way that these two things are working around.
Yeah. So just a mean reversion would be a big trade.
A big trade, yeah. It means that's why I think platinum is really on my radar to be buying that rather than gold. You know, everybody's talking about gold all the time, but here we are at a historical high for platinum. This downswing here, by the way, was the pandemic sort of situation when we started to see platinum start to revive to the upside for the first time, having been beaten down. But this ratio suggests that we're going to see platinum as a very, very big outperformer of gold.
And then silver outperforming gold as well.
Silver should as well.
We've seen that. Yeah.
Yes. Yeah.
Do you know any platinum shares that your clients buy, or I don't think there are many in the public market, are there?
Well, there's some. There's Impala and there's Impala mining, and these are South African things.
Yeah.
But you've got to have a broker that's going to allow you to trade those. You know, if you're based in the US, you might not be able to trade them. So the best thing to do, best thing to do is, I mean, I know that platinum ETFs are generally mine linked, but this one's good. This is hold on, yeah, that's platinum. That's Aberdeen's platinum ETF trust. And it looks like the same as the bullion price, where you've got this expanding flat here. Look.
Yeah.
So
PPLT, is that the symbol?
Yeah, exactly. PPLT is a good one.
Okay.
There is another one, PLTM, but so you could maybe look at either of those.
Okay. Cool.
They look good. I think they're the best way to go. Actually, that's certainly the way I'm going. I'm not going to buy any individual shares. The problem with individual shares also is the fact that, you know, you've got to know what the inside leg is on their financial statements.
Yeah.
And what their borrowings are and how much they've hedged. You know, if they've overhedged because the banks have forced them to do that because their financing levels isn't adequate, then you get a nice big price development to the upside, but you don't actually benefit that much because they've hedged too much.
Wow. some great takeaways from you today, Peter. Looking for a pretty good retracement of this recent explosion to the upside and rally into new highs up to 4,900. Be long metals, buy pullbacks. Dollar, it's peaked and could probably work that trend for years now. And your scenario in yields is different than most because most believe we've already hit the terminal rate at the high. So, so many pearls, Peter, I could string a necklace.
Well, let's hope they're
Once
not.
again.
Let's hope they're not synthetic pearls. They're the real deal.
We'll hope that these diamonds are not cubic zirconium, and I know they're not. And you know what, people that because I follow you, and people that are interested in doing so, best way you could show your website and
thanks, Dale.
show them around a minute.
Yeah, sure. I mean, obviously, if you have a Twitter or an X account, our handle is at @ElliottWave_WTI, and we're not so active there. If I get time, I'll put something really interesting on. I put week before last, I put this really interesting Apple Inc. Update. I think we've actually got to my targets now. I mean, it was at the time about 154. And it's already up to 192. So watch out for something big happening to the downside on Apple.
But let me ask you this while you're on Apple.
Yeah.
Could Apple not? Wouldn't you think Apple would take out 192 if all we're getting is a pullback in the market and then new all-time highs, or it'll be different leadership and Apple will not make a new high on the advance after this pullback?
Yeah, I don't think Apple will make a higher high like the others. This could drop really severely now. Whilst the pullback in the S&P, this 8% drop comes in, this could drop back down to this low, get a counter trend rally whilst the S&P makes a higher high or the NASDAQ makes a higher high, and then it drops. So you're going to get underperformance there. But this pattern's very specific, this nice expanding flat from 171.
NVIDIA kind of gave a failing signal last week on earnings too. I brought up earlier in the day, Peter. I don't know if you look at it, but it's kind of the darling one, the Magnificent Seven.
I've got clients who are trading NVIDIA, and I don't like it what they're doing because they're generally these big funds are generally long all of these tech stocks, and I'm nervous about NVIDIA because I think that there's fragilities in the pattern. I think if we get this downswing, as I think we should in the S&P and the NASDAQ, similar drop here. The NASDAQ's not going to be a diagonal, by the way, but simply a fourth wave correction, which means that it's going to still unfold into three waves, but it will be, and it be the same sort of percentage decline, but it's just a different wave labeling. But if that happens, it's going to send Apple quite sharply down. If it does send NVIDIA down by a similar degree of retracement from the October rally, then I think when NVIDIA goes up next, it might break a higher high. So it will outperform like the NASDAQ to a higher high, but it might be somewhere sticking around 530, 550 as a top.
Got you.
And I think then it's going to be doing a zigzag upswing from the October low, and it might become a B wave of an expanding flat, and then it will collapse later. So 530, 550 are two barriers for NVIDIA to the upside if it was to make it that far in a zigzag from the October lows. Yeah, if you can imagine.
Bonus calls from Peter Goodburn. All right, so okay.
Yeah, I mean, if you go to wavetrack.com, which is our main website, there's a couple of ways you can follow a lot of the analysis that we talked about today with oil, fixed income, S&P, NASDAQ, even Apple that we're putting into the report. You can go to registration and go subscription here, and you can subscribe to the bi-weekly report, which is the Elliott Wave Compass report, and we've got everything in there. It's I think it's pretty well priced at $39 a month. So we're giving you 2 reports per week, and if you do go into those reports, you'll be able to we'll give you a login and username, and you can log in here and see all the charts, and you can scroll them, or you can view the chart online by clicking one of the thumbnails. You can go into the view screen and see this, and then you can scroll to the next ones here, and you can download the report as well. So if you download the PDF report, you can actually store that, so you've always got that month by month. You can refer back to the forecast and see what they're doing. And yeah, so that's a great way to participate in some of the forecasts that we're doing at the moment.
Thank you, Peter. Really appreciate you coming here and sharing your hard work.
Thanks, Dale. Great to chat. Great,
yeah,
always.
Good to see you. Check out Peter Goodburn. Should be part of your intelligence gathering. And that's going to be a wrap. You could join the team in 9 minutes on the Morning Edge. People are thanking you, Peter. And
thanks very much to everybody. Yeah, thanks too.
Thanks for tuning in. And I'll see everyone. Don't just count your pips, count your blessings. And there's lots of pips to be made in 2024. So, preserve your capital. The markets will be here. And that's it, Peter. Thanks again. It was really great starting the week off with you.
Yeah, thanks, Dale. All the best to you and the team.
All right. So I'll be in touch with you, Peter.
All the best. Thanks for everybody.
All the best to you. And all right. See you, everybody. See you tomorrow. Turn around Tuesday. Adios. You're welcome.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.